There's this moment that almost everyone's experienced, standing in the checkout line, watching the total climb higher than you expected. Eggs, milk, cereal, nothing fancy, just the basics. And yet, the number on the screen feels like it belongs to someone doing a lot better than you financially. So you start to wonder, if everything's getting so expensive, why doesn't the government just print more money to help? It seems simple. After all, money's just paper, right? Ink, machines, some digital entries on a screen. Why can't we just make more of it and give people what they need? This isn't a new question. In fact, it's one of the oldest and most tempting ideas in economics, and one of the most dangerous. Because while printing more money might feel like a shortcut to prosperity, history tells a very different story. Let's take a closer look at why this seemingly obvious solution rarely ends well. Let's rewind to 1923, Germany. The streets of Berlin were chaos, not from war, but from inflation. A loaf of bread that once cost a few marks now cost billions. People carried stacks of money in wheelbarrows. Kids played with bricks of banknotes like they were building blocks. One woman reportedly burned cash in her fireplace. It was cheaper than buying firewood. This was the Weimar Republic, and what it went through wasn't just an economic crisis. It was a full-blown collapse of trust. And at the heart of it, the government had printed its way into catastrophe. Germany had lost World War I and was saddled with huge reparations payments. With the economy already in ruins and gold reserves depleted, the government turned to the printing press. Instead of raising taxes or cutting spending, which would have been politically painful, they started printing more and more paper marks to cover their obligations. On paper, it bought time. In reality, it destroyed the value of the currency. By late 1923, prices were doubling every few days. Wages couldn't keep up. Pensions became worthless. And people who had worked their entire lives lost everything. It wasn't just about economics. It was about dignity, stability, identity. When a currency dies, it takes trust down with it. And it wasn't just Germany. Similar stories played out in Zimbabwe in the 2000s, Venezuela more recently, and Hungary in the 1940s. The worst hyperinflation ever recorded. In each case, leaders turned to the printing press in moments of crisis, thinking they could stimulate the economy or buy time. Instead, they ignited a wildfire. But why does printing more money cause prices to rise in the first place? Let's break it down. Money isn't valuable because it's backed by gold or silver anymore. In most countries today, including the US, money is fiat. It has value because people agree it does. That agreement is fragile. It's based on trust in the government, the central bank, and the idea that the money supply is being handled responsibly. When more money floods the system without a corresponding increase in goods and services, each individual dollar, peso, or euro becomes worth less. That's inflation. Imagine you're at an auction and there's only one painting for sale. If there are just 5 bidders with limited funds, the price stays low. But if everyone suddenly has unlimited money, the price shoots up, not because the painting is better, but because money is everywhere. Now apply that idea to an entire economy. In normal times, central banks like the Federal Reserve manage inflation by controlling the money supply, raising interest rates, selling government bonds, tweaking the system to keep prices stable. But if a government bypasses these checks and prints money directly to cover spending, inflation can spiral fast. Still, people ask, what about during crises? Didn't the US print trillions during COVID? It's a fair point. In 2020, the Federal Reserve and US Treasury injected massive amounts of money into the economy through stimulus checks, business loans, bond purchases. It was money creation, and it helped avoid a deeper recession. So why didn't it lead to hyperinflation? Well, several reasons. First, the US didn't just hand out cash without thinking. It was targeted, it was temporary, and it was done alongside tight monetary policy planning. Even then, inflation did rise after the fact, especially in 2021 and 2022, as supply chains buckled and demand surged. We're still feeling those effects. But crucially, the US dollar is the world's reserve currency. There's built-in global demand for it. That gives the US more room to maneuver than a country like Zimbabwe or Argentina. But that doesn't mean the rules don't apply, just that there's a longer leash before things snap. In countries without strong institutions, printing money often becomes a way to paper over bigger problems: corruption, mismanagement, war, sanctions, or collapsing revenue. And that's where the real danger lies. Because once people lose confidence in the currency, it creates a feedback loop. Prices rise, people spend money faster before it loses value. That increased velocity pushes prices even higher. Businesses can't plan. Savers get wiped out, and eventually, the money becomes so worthless that even those giant stacks of bills can't buy a loaf of bread. It's not always dramatic hyperinflation either. Sometimes the consequences are slower, but just as damaging. In the 1970s, the US faced stagflation, a painful mix of stagnant growth and high inflation. Part of it was due to oil shocks and supply issues, but loose monetary policy played a role too. It took sky-high interest rates in the early 80s, up to 20%, to break the cycle. And those rate hikes triggered a brutal recession. So, if printing more money doesn't work, what can governments do when they need cash? They can borrow by issuing government bonds. That's what most developed countries do. Investors lend money to the government in exchange for interest payments. It's not a free lunch, but it's a controlled mechanism. Or they can raise taxes or cut spending. Less politically popular, but often more sustainable. Modern monetary theory, or MMT, argues that countries that control their own currency can print money to finance deficits, as long as inflation is kept in check. It's a controversial idea. Some economists see merit in it, especially for rich nations with slack in their economies. Others warn it's a slippery slope. And in some cases, like Japan, large government debt and massive money creation haven't caused runaway inflation. But Japan is unique: an aging population, a strong culture of saving, and deflationary pressures. So, context matters a lot. Still, the broader lesson holds: money only has value when people believe in it. When governments break that trust by printing recklessly, the results aren't abstract, they're devastating. We see it in photos. People in Caracas carrying bags of bolivars to buy groceries. Middle-class families in Harare priced out of basic goods. Savings accounts wiped clean in a matter of weeks. Money is, at its core, a shared story, a belief, a tool for exchange and measurement. And like any story, it needs consistency, credibility, and care. That's why central banks exist, why economists obsess over interest rates and inflation targets. It's not just academic, it's about maintaining that fragile balance between how much money exists and what that money can actually do. Printing more money sounds like a fix, but more often, it's like pouring gasoline on a fire, especially when the fire is already smoldering. At the end of the day, this isn't just a story about economics, it's about trust. Every time you tap your card at the store, every time your paycheck hits your bank account, you're relying on an invisible agreement that the money you earn today will still be worth something tomorrow, that the price of eggs won't double overnight, that your savings won't vanish because someone behind a desk decided to print their way out of a budget shortfall. When that trust breaks down, money stops working. not just as a currency, but as a concept. And while the temptation to just print more will always be there, especially in times of crisis, the evidence is clear. It's a short-term fix with long-term costs. Not always instant collapse, but erosion of value, of planning, of fairness. Because inflation doesn't hit everyone equally. It punishes the poor first. People on fixed incomes, small business owners who can't raise prices fast enough to keep up. And it creates an illusion of prosperity, while quietly pulling the rug out from under the people who can least afford it. So next time someone asks, why can't we just print more money? Remember, it's not about ink or paper. It's about faith. About what happens when a society decides that shortcuts are easier than hard choices. If you found this breakdown helpful or eye-opening, we cover topics like this every week. Real-world money questions, economic history, and how it all connects to your life today. Subscribe to stay informed and let us know in the comments. What do you think is the most misunderstood part of how money works? Thanks for watching.